Well, hello and welcome to the special edition of Brexit, the aftermath, as we're getting more reactions from investors, economists, members of the business community to the outcome of the vote last week, where the UK decided to step out of the European Union. We've been getting you a whole host of important voices on the matter and what this vote would mean for the rest of the world, its implications for the world economy and for world markets, which have been on tenterhooks and have been volatile. Now, a lot of developments are taking place right here in the epicenter of this issue, which is the United Kingdom. You've had a leadership crisis in the Conservative Party, which is, effort is being made to resolve that. There has been a leadership crisis in the opposition party already. There's much talk about how the United Kingdom, if things don't fall in place in terms of appointment of a leader and that doesn't work well with the opposition, could go in for an early general elections as soon as September, October, and that's keeping a lot of uncertainty looming still on the overall business as well as economic climate. And not just that, even in terms of market realities, while the markets have staged a rebound, we've seen the pound also come back a bit. The pressure continues in terms of how much downside risk is there in the markets from here. Most investors, most business people that we've spoken to believe that the downside risk cannot be assessed right now. There could be significant to measured downside risk. However, even if there is an upside from here, that would be only a technical bounce back, and the upside is really capped for the markets, as also the upside is really capped for the economy. So over the next 6 months, yes, there will be slowdown in economic activity. Yes, US will be hit by a mild recession. In fact, Goldman Sachs has already put that out, that come 2017, the UK would dip into a mild recession. Now, the Eurozone economy will also scale back a bit, to the tune of 0.5 to 0.7% on their overall GDP. On the other hand, you also have the European Union, which is resolving its stance. In fact, its union, so to speak, to ensure that they come together stronger. Some radical proposals have been put in place by the finance ministers of France and Germany, talking about how they need to, do away with borders. They need to allow free movement of goods and services and people. How the European Union, as is, needs to come together as a stronger entity with this one loss of member that's come by, and the 27-member trading bloc needs to be stronger than before. But, it's really about the state of the economy. And that's what everybody's watching out for. I spoke with Russell Napier, a market historian, somebody who correlates markets with economics and the patterns there. And he highlighted how the problem is not so much about the UK, because it has an independent currency in the pound. It has reserves in the pound, assets in the pound, which is also one of the reserve currencies of the world. The greater risk is about the European Union staying together and what happens with the fate of the euro, which is the common currency, bringing the bloc together. Hear him out, his views on the risk that there is on the economic outlook as well as the political outlook in the trading bloc, in the 27-member trading bloc.
Well, I think global inflation is coming down, which is always beneficial to India. And the good thing about India is it's not reliant on that old model. That old export-orientated model is not India's model, so it can be much more flexible in turning around for this new era we're heading into. So if the world begins to look at emerging markets as a different type of world, India will be one of the first places they look at. But until China makes its adjustment, given how huge it is, to me it's just too dangerous to buy any emerging market until that's out of the way. Okay. That could be a fifth grade bottom, by the way, after that adjustment, but equities would be a lot cheaper. India has policy flexibility to try and deal with all this, so that doesn't make me optimistic. But imagine if you lived in a country without that policy flexibility. Imagine if you lived in Greece or Spain or Italy. So, clearly India is going to look better than many places, but that doesn't necessarily make you bullish on the equity market. People have to realise why a lot of people voted out, and that was just to have a sovereign parliament, a parliament where every day I go to the ballot box, I can fire any incompetent politician. It's an important thing to be able to do, and now there isn't a politician making my laws that I can't fire. So we are now as independent as India. I think it's a wonderful day. There are huge costs, there are huge prices to pay, but there are many things in life more important than money. In terms of market impact, obviously all that anybody cares about is not the United Kingdom. The questions I get asked are what's going to happen in Europe. Are there any other peoples in Europe who feel the same way, that they'd like an independent parliament and not the pooling of sovereignty? And it's crucial to say that all over the world states cooperate. They pool their interests, they cooperate. It's a wonderful thing. We all do it. We do it with India. Canada does it with India. That's different than a pooling of sovereignty. So the vote is not against Europe. The vote is against a pooling of sovereignty within Europe. So now we progress and we go forward. But the key market question is a very simple one. And that is, monetary policy is seen to have failed already before Brexit. I think the Central Bank of Europe and Japan and others had got as far as they could. So the only question that really matters now is, will Mrs. Merkel back down from austerity and this enforced austerity across the rest of Europe? And if we answer that question, we know a lot about financial markets in the near term and a lot about whether this political integration of Europe will actually succeed. Because I think without her doing that, it's going to be extremely difficult to make this political integration work for the rest of Europe.
Right, but let's start off with the key concern on how the situation would look like with the UK stepping out of the EU, for both the parties. So, there's a risk of a recession, and Goldman Sachs has come out with a report saying, perhaps by the end of this year, there would be a mild recession in the UK. You would see the GDP of Europe getting hit by about 0.5 to 0.7%. How do you look at those numbers? How do you look at the immediate, reaction that the economy, or the backlash that the economy could face in terms of investments, and that trickling down into earnings and thereby, keeping the markets under pressure?
Sure, I think there's no doubt there's a negative hit from this for both the United Kingdom and Europe. And in many ways, it's likely to be worse for Europe. And I know that sounds very peculiar, but Europe already had a banking crisis building up, particularly in Italy. And this is long before the Brexit vote. I mean, people are going to blame a lot of this on Brexit, but many of these things were happening anyway. The situation in Italy is so severe that we can even use the word banking crisis developing there. And it's not just Italy. We look at Deutsche Bank and we look at how far its share price has fallen now, just to stress, all before Brexit, and of course exacerbated post-Brexit, but already happening. Credit Suisse. Monetary policy is failing. So the question for the United Kingdom, for Europe, is all the same questions. If it's not working, what do we do next? Now, I know no one's talking about it for the United Kingdom. If absolutely necessary, we could do this large fiscal spend. The most striking thing about financial markets post-Brexit is that the yield on British government debt came down. Now, this is a country that runs a huge current account deficit. I know in India you're always worried about your current account deficit, but ours is even bigger.
Not anymore. I think the situation has improved quite a bit in India.
Yours is better than ours is. So one of the great concerns for anybody who voted out on these constitutional reasons is, oh my goodness, we may not get as much foreign capital and yields might go up, and we don't get as much foreign capital. The sterling's adjusting, but yields aren't going up. So that leaves this option to the government of, contrary to what our Chancellor says, of not doing an austerity budget, but actually doing an expansionary budget if necessary. But Europe is much, much more difficult because the Germans have set their face against expansionary fiscal policy, particularly at a time when the central bank is expanding its balance sheet, because the combination of those two things could be called helicopter money, and constitutionally the central bank is not allowed to do that. Now, just because it's in its constitution that it's not allowed to do it doesn't mean to say it won't do it. And I'm raising the question, will Germany change its mind? So we've got to remember there is one more policy to go to, but it's not one that has been used post-war in any developed world country, so it's quite a big step for everybody.
Donald Trump is calling the end of the European Union as we know it, and perhaps the breakup of the common currency in the euro. We'll talk about the helicopter money theory as well, because that's one that's gaining ground among what more ammunition do central banks world over have to tackle the situation. But first and foremost, do you think that this is paving the way for a deeper crisis in the making, which could be in the breakup of the EU?
It would be embarrassing to agree with Donald Trump, wouldn't it? So, but I do agree with Donald Trump that the political union is failing. And that's not to say that there won't be a European Union, and it's not to say that there won't be a political union, but I can't see all current members being member of that political union, that some of them will also have referendums and some of those people will also vote to end the pooling of sovereignty. I think it's fairly natural. I think what's interesting in the Spanish vote is that perhaps the people who may have shifted their opinions are actually in Northern Europe. And that is particularly worrying, I think, for the European project, that it's the people in Northern Europe who may be becoming less keen on this. So yes, now it's I've always said this, if there were two countries having a vote on remaining in the political union, and one was Finland and one was the United Kingdom, Finland would be much, much more important.
Right. But isn't this
anybody who's voting who's in the Eurozone, we've seen some significant economic dislocation from the United Kingdom voting to leave this thing. You ain't seen nothing yet if we get a Euro member voting to leave. And just one final point on that. I think it is important that if people get a right to vote in Europe, capital will be moving all over the place if there's a euro member having this vote. I think they would put in exchange controls. I think some restriction on the free movement of capital while the people exercise this really crucial, important constitutional decision is likely. So for financial market participants, that would be everything. Whether the economy is going up or down is not important if they're putting on exchange controls. So as this democratic process works itself out to see what the union is, then I think some form of restriction on free movement of capital is likely.
Right, but Russell, isn't there a lot of if, but on that situation, because you don't know how leadership would, shape up in the United Kingdom, what that would mean, whether there would be, another round of general elections, what would that do for, the vote of the public and the thought process that there is in lieu of the backlash that we've had to the outvote, and, how that would then influence under the new leadership the ties with the European Union. It could well happen that, the trade agreements and the nature of the relationship could be just another chapter in the same book. So you might go back to square one 6 months down the line, especially if Article 50 is not invoked. And it doesn't seem like the UK government. What I'm trying to, highlight is that it's not done and over just as yet. So do you think that the market reaction from here on would be one which is calibrated, unless there is some bad news staring at you in the face in terms of a complete breakdown of the machinery? Things would be okay, the markets will stabilize.
Yeah, I don't think the market's going to be in the least bit concerned about the United Kingdom. It's only ever going to be concerned about Europe. And the United Kingdom has a currency which will take most of the pressure. It could have a recession. It has an independent central bank, well capable of dealing with any liquidity issues in the banking system. The banking system is effectively owned by the state. They'll be paying, it'll adjust. The market is only concerned about Europe. And so what you've said to me, I'm afraid is even more complicated than that. It's not just we'll have political changes underway in one party that's in the negotiations. We'll have it underway in the other one, which is the European Union. So there is really a feasible outlook that 2 years from now we begin to complete the process of negotiation with something that looks more like a European common market than a European political union, and that would go back to voters. I think what could easily happen is that in 2 years from now we go back to voters and say, you voted against the political union, but this thing is changing more towards a common market, and we'll have a second vote, and we've done this specific deal with this organisation, and would you endorse that? So that is definitely possible, but it's not within 6 or 9 or 12 months. It's going to have to wait a couple of years for things to settle down.
So do you think that the market's reaction for now is done, the panic reaction, the pain is out of the system, or would you believe that, with this jolt, it's back to square one? We are back to at the start of the year when the markets are really worried about China, commodities, crude. It's a similar situation now where you're worried about what this fallout would mean for the rest of the world in terms of just economic activity, trade dealings, etc., and also sentiment. And then, you're staring at US presidential elections. So do you see a very tough second half of the year? Or perhaps, we would be dwindling around these levels?
No, this is definitely not over. I mean, once again, this Brexit is just a thing that happened in a long process. And the long process is we've been trying for over 5 years to reflate the global economy using monetary policy. And it's constantly failed. And this has exacerbated the failure. Now, the markets have bet a lot on the success of this. The markets have bet a lot that central bankers can return us to growth and inflation. And the markets are wrong. And when they begin to realise that, they're going to fall. Now, the only policy response from here is this helicopter money. I feel strongly that it wouldn't be done across the board by all countries. But I also feel strongly that Japan might start that process because Japan has run out of options more quickly. So we could debate that. But the really interesting question for every global participant is what will Mrs. Merkel do about her austerity programme? That's all that really counts. There is only, to me, if monetary policy fails, one answer, and that is that. But the Germans constitutionally are against it. It's not, we don't think the economy is good and we think we change the economy. Constitutionally, morally, psychologically, the Germans have got a thing about doing helicopter money because it's a horrific period of their history, the last time they did it. Now, to save the political union, because it was going to be much easier to save it against a background of growth, stable financial system, stable banks. Is she prepared to cross the Rubicon and endorse this project? And you may have noticed by now that I keep putting this to you as a question and not giving you the answer because I don't know.
Well, that was a macro view on how things look like for the economy, for markets, for the currency world. But what about emerging markets? So far, over the last few days, we've talked about how the UK divorce with the European Union would impact market sentiment, would impact investor sentiment, would impact business confidence. There would be scale back in investments from top businesses right here in the UK as the uncertainty still needs to settle itself out. But in lieu of all of that, the focus on emerging markets, does that increase? Because you're seeing a lot of anti-globalization, thought processes impacting, the view on the developed markets and the developed world. Where does this lead the emerging market story? Are emerging markets completely insulated? Or given the linkages in the global economy and world markets, are emerging markets as vulnerable still at this point in time? What happens to EM equities? What happens to EM bonds, fixed income, credit markets, the currency markets, which had quite a tumble at the start of the year? Bhanu Baweja, who's a global head of emerging market strategy at UBS Investment Bank, highlighted the risk in emerging markets and put things in perspective. He believes that yes, the wave is pro-emerging markets given all the turmoil in the developed world, but the upside for emerging markets also seems to be capped and the opportunities are few and far between, and it's going to be very selective as to where you park your money and try and generate returns in that investment. The universal view is it's a flight to safety and buy safe haven assets.
The risk is that call could be penny wise, pound foolish, right? In that that could work perfectly well in the very near term because, yes, of course, the epicenter of the earthquake, if you want to call it that, is in Europe, is in the UK, and you'll have trouble in this part of the world. And emerging markets, therefore, seem to be relatively fine, right? So over the next 3 months, perhaps even over the next 6 months, people will go and chase yield in emerging markets. People will go and chase carry in emerging markets. The only problem is that when we've seen this story before, we've seen this movie several times, right? If you do get uncertainty in terms of global growth, it's very difficult to argue that emerging markets will outperform over the medium term. And when I say medium term, I don't mean 10 years, I mean even 12 months. It's going to be quite difficult for emerging markets to outperform because let's remember the context in which we have had this referendum vote. It's one where globalization was already plateauing out. Right? Several Asian economies have seen exports slow down tremendously. India itself is seeing export volume growth, which is very poor. Right? Now, in this context, when the relationship between trade and growth is already weakening, if you're going to see coming to the headline issues like the referendum, issues like the stability of the Eurozone, that's not going to help. Right? If globalization slows down, emerging markets are going to get hurt. We have to keep in context. To what extent have emerging market economies benefited from globalization over the last 20 years? We oftentimes think it's because it's inevitable that EM will do well because of demographics. It's inevitable that it'll do well because of productivity. But it's not. Right? Globalization has been a huge part of emerging markets doing as well as they have done in the last 20 years. And since it's plateaued out, sure as clockwork, emerging market has suffered. So if this is another nail in the coffin for globalization, then that's going to be a big problem.
So what is your emerging market strategy right now?
So we are receiving emerging market rates. We are long fixed income, but not in equity. Because I think effectively what we're doing is we're taking a balance sheet bet in emerging markets, saying that the balance sheet is deteriorating, but at a very slow pace. By definition, it's a stock variable, it deteriorates slowly. So we are in the fixed income universe, but we think that the equity universe, it's going to be very difficult for EM to outperform developed markets over any sensible time like a year.
So when you're talking about fixed income, essentially you're talking about good rated corporate bonds, you're talking about government bonds within the emerging market.
Primarily government bonds, but also investment grade corporates, right? So that's where we would be relatively overweight in EM with respect to developed markets. But growth-seeking assets, such as equities, growth-seeking assets, such as currencies, that's where I think the problem lies. So even when you take fixed income risk, we are very careful about either hedging out the currency risk or being in selective places where we think the currency risk is okay.
Right, but how do you look at the currency risk in emerging markets right now? The Indian rupee has been fairly resilient. You've had, of course, issues with the Turkish lira, that historic fall in emerging market currencies last year. The yuan now getting depegged against the dollar, so further devaluation seen there. Is that an opportunity, you think? Because from this point, there could be a technical rebound that could take some of the weaker currencies higher. We've already seen that in the first half of the year. Or perhaps take exposure to the rupee, which again hedges your bets to the investments that you're making within the bond market.
So we have been long the rupee within the emerging markets universe till very recently. We have recently decided to actually go back to neutral on the rupee for several reasons, amongst them being the fact that export competitiveness, I think, has taken a big hit. Okay. But more broadly, right, once again, we have to put this in context. Emerging market currencies have been depreciating for 5 years now. 5 years. Typically, this is the kind of time over which you say, well, this is a bottom and I really should go bottom fishing, and perhaps this is a time for a rebound. Why is it not happening? Why are we not seeing exports pick up? Why are we not seeing global trade pick up? It goes back to where we started the discussion.
Well, that was Bhanu Baweja putting the spotlight on emerging markets and advocating a prudent strategy to approach the asset class from an investment perspective in comparison to what's happening in the developed world and the turbulence that those markets are witnessing. We hope you enjoyed this exclusive coverage of Brexit, the aftermath. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.